Today we're diving into a big question that's on everyone's mind. Can unaffordability crash the housing market? Hi there, it's Tom Olsewski with eXp Realty coming to you from beautiful Temecula, California. You've probably felt it. Prices feel out of reach. Mortgage rates are high, and there's still this gut feeling that the bubble is about to burst, especially if you've been through it before. But is the market actually heading for a crash, or is this just fear talking? Stick around, because by the end of this video, you'll understand what's really going on with affordability, home prices, and the future of the market. So let's rewind a bit. From 2012 through 2019, home prices rose steadily, kind of like a slow jog. Nothing crazy, pretty much in line with income growth. Then COVID hit. Suddenly we had 17 record low interest rates. Buyer demand exploded, supply was tight, and prices, they took off like a rocket. In 2022, rates jumped from 3.25% all the way to 7.37%. Prices dipped briefly, but then from 2023 through now in 2025, prices began to rise again. Overall, home values are up 54% since January 2019. Now, a lot of people feel in their gut prices have to fall. It feels like a bubble. It feels unsustainable. I hear it all the time, but that feeling doesn't always match the data. So let's dig in and look at the facts. Nothing but the facts, Jack. According to data from Calculated Risk and the National Association of Realtors, in 2019, a $50,000 income could afford 28% of the homes nationwide. Today, just 9%. A $75,000 or $100,000 income used to qualify for 49% of the homes, now only 21%. Even at $150,000 a year, affordability dropped from 80% to just over 60%. Why? Because since 2000, household incomes went up 40%, but home prices soared 197%. That's a massive gap, and it's not just a national story. Location matters. California, Nevada, Massachusetts, Florida, and most of the West Coast are among the least affordable places to live. The Midwest and Central U.S. are doing better, but even there, it's worse than before the pandemic. So yes, affordability is a nationwide challenge. Affordability comes down to three key factors: mortgage rates, household incomes, and home prices. So right now, rates are stuck around 7%. Incomes are only up 23% since 2019, and prices up 54%. That's not a winning formula for affordability. So if rates don't come down and incomes don't shoot up, everyone thinks prices have to crash, but not so fast. Crashes require one thing above all else: supply. And today's inventory is at just 1.33 million homes. That's less than half the inventory before the Great Recession. Plus, buyer demand has been low but steady since late 2022. No surge of sellers, no panic, no collapse. In 2008, we had subprime loans, adjustable teaser rates, people walking away from negative equity, fraud and foreclosure galore. Today, 40% of U.S. homeowners own their homes free and clear. Fixed-rate mortgages are common. Equity is at record highs. This isn't a replay of 2008. So what happens next? Some smaller markets, especially in Florida, are seeing 7% price drops. But for most markets, we might see a 1 or 2% dip, or even just flat prices. What they call the goose egg effect, zero movement. This is the strongest housing market we've ever had in terms of the fundamentals. fixed payments that protect against inflation, high homeowner equity, stable job market, and most important, very few distressed sellers. It's not a house of cards. It's built very solid. So can unaffordability crash the housing market? Not likely. Unless we see a major shift in inventory or employment, prices may soften, but we won't see a full-blown crash. If there is a drop in interest rates, there could be an increase in home values and buyer demands driving that. Rates have dropped slightly over the last couple of weeks, so if it continues in that direction, good things. If you found this helpful, hit the like button, subscribe to the channel, and drop your thoughts in the comments. And hey, if you're buying or selling in Southwest Riverside County, reach out to me. I'd love to help guide you through this market. See you in the next one. Thanks for watching.